We have several colleagues from our faculty who have joined. I have my friend Chuck Thomas from Texas, who is here.
Oh, okay.
And uh, um, Professor Matarocci from Italy, he should be joining as well. Gianluca.
Can you see the participants or?
Yes, you can if you click on the participants tab, the icon, because you are one of the panelists.
Yeah, okay. Yeah. Ah, now I see. Yeah, okay. Dropping in. Yeah.
So I see representation from Bangladesh as well. So we will perhaps wait for 2 more minutes before we start. Riddhi, is that okay?
Yes, sir.
Yeah. 30 more seconds.
Good evening. A warm welcome to all of you to this webinar. In particular, I welcome Professor Roland Foues, University of St. Gallen, Switzerland. Uh, uh, Welcome to the Misra Center for Financial Markets and Economy, Indian Institute of Management, Ahmedabad. Just to give a brief about the center, what we do, this center undertakes research on financial markets and economy, in involving issues relating to monetary policy, fiscal policy, central bank's mandate, and also it covers many other areas like real estate, market microstructure, including commodities, banking, bond market, SME financing. I think just to give some of the areas which we try to explore here, we also facilitate wider scope for research and research by faculty and PhD students working primarily in the intersections of finance and economics. We are also engaged with stakeholders, who influence policies, as well as with the people who are influenced by those policies. Okay, so it's a center of applied research, primarily at the intersection of economics and finance. With Prashant joining here, we are emphasizing many other applications of research, including, I think, the relevant fields in the real estate primarily on empirical research on real estate side. Okay, so I think with this brief introduction, I hand over this to Professor Prashant Das. Over to you, Prashant, to take.
Thank you very much,
Thank you.
Abhiman. Good evening, ladies and gentlemen. I'm Prashant Das, your host for tonight. I serve as an associate professor of real estate finance at IIM Ahmedabad from the finance and accounting area. Residential real estate is one asset class that all of us are exposed to. There are those who buy homes to live in them. Then there are some others who see home buying as an investment. Beyond individuals and households, there are institutional investors too, who invest in houses either in the short run or in the long run. Unlike the fungible financial assets, however, this asset class has very specific characteristics that require specialized research and understanding. Today's paper helps us understand how investing in homes has meant different returns and risk exposures to different types of investors in the United States. Today's presenter, Dr. Roland Fuss, joins us from the beautiful landscapes of St. Gallen, Switzerland. Dr. Fuss is the Dean of the School of Finance and a full professor of real estate finance at the University of St. Gallen. I have known Roland for over 8 years, and I have had the opportunity to collaborate with him on several projects. I remember when we invited him to EHL Lausanne for a very similar talk, perhaps 7 years ago. I had only known him as a leading researcher in Europe. So when I moved from US to Europe, there were some leading real estate researchers that I knew about, and Roland was definitely on the top. Then we learned that he is also a professional painter, and he has worked for legendary artists like Gerard Richter. Equally adept at financial theory and empirical modeling, Roland's creative ideas in finance and real estate research are impressive. He's often invited for keynote lectures around the world. We are very glad that he accepted our invitation to present this paper. Needless to say, he has numerous papers in top finance, real estate, and economics journals to his credits. You can see his web profile to explore more. All you need is Google. Today, he is presenting his paper titled Investors in Housing Market. Attendees, if you have questions or suggestions, please post them in the Q&A box. I will post them to Dr. Fuss at the right opportunity. Dr. Fuss, I may sporadically interrupt you by reading the questions out. And in the end, we shall also try to have a Q&A session. In the meanwhile, while Dr. Fuss starts speaking, I will turn some of you as panelists so that if you feel like asking questions, you can ask those questions directly as well. If you don't have any questions to ask, please keep yourself muted after I have turned you as a panelist. Over to you, Dr. Fuss.
Okay, thank you very much for this nice introduction. And thank you very much for having me, at least virtually, or unfortunately virtually. So it's a very great pleasure to be here and to present this paper. This paper is a joint work together with Marcel Fischer and Simon Stehle. Both are with the University of Constance, as well as a former PhD student, Daniel Ruf, who is now with the Goethe University in Frankfurt. So the main idea of this paper is to study how different, and I think a huge part of the paper was already explained by Prashant. So the main idea is that we study the investment behavior, the risk-taking behavior, also somehow if there is some selectivity ability, or if there is a timing ability of different types of investors in the housing market. So far, we know a lot about households and how they behave. We know that they have, for instance, sometimes some incentives to buy homes as a hedge for a future housing risk, and that might also change the demand for housing, but also local markets such as MSAs in the US, and that also leads to spillovers between different MSAs, and at least, or even, it leads to, for instance, a negative relationship between risk and return. There's a lot of, when we think about household finance, we know a lot about how households finance, for instance, their real estate, their properties or homes, and this is also related to financial literacy. But if we, read, magazines, newspapers, and so on over the last years or the last decades, we have also seen that there are other investors active in the housing market. So there are hedge funds, for instance, which we later on will classify as short-term investors, in particular after the great financial crisis. There were a lot of foreclosures, and the US government, for instance, incentivized, for instance, these investors to invest in the single-family home markets. But there are also long-term investors due to the fact that there were, tight mortgage lending and a huge supply. So the technological advances allowed them, for instance, to also directly invest in the housing market, because managerial as well as acquisition costs, they decreased. And here are some examples from the press, which also, give us an anecdotal evidence that hedge funds, institutional investors are indeed active in these markets. And the question is, how do they behave? There are some papers which look at these different types of investors separately. They also look at foreign investors. This has something to do with information asymmetry. They pay, for instance, higher prices, have lower capital gains, and so on. But we want to analyze them jointly, and we want to know why do some of these investors perform much better, and what explains this outperformance of these investors. And when I say these investors, I mean the short-term institutional investors, which we'll see in a few minutes. I already mentioned that there are some papers which look at different investors in the housing market, so nationally as well as internationally. So some, as for instance, Bayer et al., they looked at middlemen, and they also came up with the result that middlemen buy, for instance, or purchase properties at below market prices and sell it above market prices. But there are also speculators which are, paying essentially the market price. Both of types of these investors didn't anticipate, for instance, the burst of the bubble in the US housing market. There's a paper of DeFusco et al., who looks at short-term speculators who destabilize, for instance, the housing market. And Few et al., for instance, for the Singaporean market, which study the introduction of transaction tax, which this tax stabilizes more the prices, but also reduces, for instance, the price informativeness. And there are other papers, as I already mentioned, such as the one of Jinko and Meyer, as well as Jivanovic and Spanias, who look at foreign investors out of town and foreign investors in the Paris market, so in the Paris housing market. So they have longer holding periods, they pay higher prices, and as I said, there are information costs, searching costs, or asymmetric information, and so on, which also reduces at the end the capital gains for these investors. And additionally, we see here at the last bullet point, there are studies about long-term institutional investors. When we think about pension funds, for instance, I already mentioned this, that it becomes now more beneficial for them to invest in single-family home markets because the costs also lower. So that means the acquisition and the managerial costs for these investors. And there was actually, after the financial crisis, a huge supply as well as a tight mortgage lending, which also allowed them to enter, for instance, the housing market. So these are all reasons why there are evidence, anecdotal evidence, but also empirical and evidence from these papers that there are different investors active in the housing market. So when we summarize this more or less, and we would think about, different types of investors at the very beginning, we can classify them more or less also due to the literature, what we have learned from the literature, but also in general, we have a huge part, which is the owner-occupiers. Then we have private investors. That means households who buy a second home, and then we have the institutional investors, which we can split up in short term. That means when I say short term institutional investors, I mean these are defined as investors with a holding period or investment horizon of, let's say, up to 3 years or lower, but at least larger than 180 days, because if it's shorter or within this span of 180 days, we would classify them as these trades as heavily speculative. So these are, land speculation or new construction or significant or substantial renovations. And then at the end of this spectrum, we have the long-term institutional investors. As I already mentioned, these are pension funds. So they don't care so much about, short-term fluctuation in the prices. So they have a long-term perspective. They are rent-seeking together with also, the private investors. So the main task now is in this paper that we said, okay, what drives, what are the drivers of the different returns or capital gains among these different types of investors. We first of all hypothesized that there are the two main drivers might be momentum as well as risk-taking or local return risk. So what does this mean? So when we look at owner-occupiers, they care more about, consumption. That means the risk-taking and the compensation for risk-taking is of, secondary importance for them, because they look, for properties according to their taste and preferences and so on. So they are less affected by momentum as well as this local return risk. Whereas private investors are rent-seeking, so they want to have savings for retirement, for instance, and it's the reason why they invest in a close-by second home, for instance. So they depend more, or the dependence on momentum as well as return or local return risk is much higher. And the same applies for the short-term institutional investors, because they are rent-seeking and they want to, make earnings or capital gains in a very short holding period. Whereas again, for the long-term institutional investors, they are again less affected by momentum as well as this local risk or return risk. So when I say local return risk, I mean that this is a local real estate market, and it has so we see a heterogeneity among these markets, where we have markets with higher local return risk and lower local return risk among counties. So in the empirical analysis, we in particular look at locations which are defined as counties. Now, here you see a graph, maybe as a first motivation why there should be, different returns and why different investor types earn, for instance, different capital gains. So this is taken from a different paper where we analyze how higher moments in the housing market returns are compensated or affected by fundamental factors, and then in the pricing model, are these higher moments priced, for instance, in the market? And what's very obvious is when we look at short-term institutional investors here at the bottom left, we see that they are highly skewed. We also see the same pattern along the real estate cycle. So when we start below in 1995, go up to 2017, we see the financial crisis, the great financial crisis, again, where we have a left skewed distribution. But we see that the distributions are much broader for short-term institutional investors, where they are more similar along the real estate cycle for long-term institutional investors, because they have, as I said, more or less a buy and hold strategy. So it seems that these short-term institutional investors heavily deviate from the distributions of the other investor types. But this is descriptive statistics, so we will see later on when we use a more formal analysis if this is confirmed. But in general, we can summarize, and as already Prashant at the beginning said, the market participants are highly heterogeneous in the real estate or housing market. So when we think about households, owner-occupiers, they focus on consumption, their consumption yield, and they are less driven by financial gains. There might be also somehow, an anchoring. So later in the empirical study, we will also distinguish between different dates. So we will distinguish between purchase date and sale date because there might be different conditions. And they may also differ, right? So sometimes they anchor more when they want to sell a property than when they buy a property. And as I already mentioned, there is speculation, so pure speculation on capital gains versus, for instance, long-term renting out the property, as we see, for instance, for pension funds versus, more speculative trades done by hedge funds. So the big question is now, when we look at our previous graphs and the distributions, so why do we see these different distributions, and what drives the returns, the capital gains? So that means without the income component, so without the rent component, what drives these capital gains in the housing markets among different investor types? And we argue, and when we think about, this heterogeneity among the market participants, as I already mentioned, so some are more, dependent on momentum and risk-taking or this local return risk, where others are more independent of momentum and take less care of, for instance, the risk compensation in terms of return. So our focus is on to explain these capital gains by, on the one hand side, is momentum relevant, and does momentum drive, for instance, these capital gains, or is it local return risk, or both? And as I said, we do this in different ways, and in particular, we distinguish between the sale date as well as the purchase date. So when we think about these two channels, we have to control for all the other channels. So we can think about financial variables which might drive, for instance, these capital gains. So there might be some local real estate markets where we see low unemployment rates, high income, and so on. So do they trade on these local fundamentals, or are there some other financial variables such as, for instance, loan-to-value ratio, and so on? So that means we have also to test, the different or other channels, so that we make sure that it's not affected, that the capital gains are not affected by other variables, as I said, for instance, these macro fundamentals or financial fundamentals. So that means the contribution to the literature is that we investigate together, these different, as I mentioned, these 4 different investor types, and we ask what is the role of local return risk in driving, for instance, these capital gains and the returns in these markets. And we contribute to the literature, on the relationship between risk and return, as I already mentioned. So if households, for instance, have the incentive to buy a home to hedge against housing risk, that might also drive demand in these markets, but it also shifts, for instance, demand among different MSAs. And it also somehow leads to spillovers and also to a negative relationship between risk and return, because for the household it might be more important to hedge housing risk then to receive a compensation for taking this risk. And this hedging literature is mainly provided or done by Han 2010 and Han 2030, and we want to contribute in a certain dimension to this literature, where we distinguish between a return and risk, or we study the return risk relationship in the housing market. Now, for our motivation, this graph shows the different types of investors. You see the analyzed capital gain by investor, by our 4 investor types. We see that we have the lowest return earned by the owner occupiers here below. So the solid line with the circles. It is then followed by more or less the private investor. By the way, this changed a little bit. So there is a huge change after the great financial crisis. I will come back to this later on. I already mentioned this at the beginning, right? When we thought, or when I discussed the foreclosures and speculative trades, and particular short-term investors invest, such as hedge funds invest, for instance, in these foreclosed properties. And we see this, for instance, here when we look at the pattern of the short-term institutional investors. So they deviate heavily from the others, in particular after the financial crisis, but they always outperform the others. So the ordering of the outperformance, so the relative performance, is very stable. It only changes between, as I said, between the private investors and the long-term investors after the financial crisis. But it's very stable, and it also indicates that they follow more or less the same strategies in investing. Now, coming to the empirical analysis. So we make use of a huge data set. This is CoreLogic. So CoreLogic is a data provider in the US, covering the US housing market, covering more than or roughly 97% of all nationwide transactions in the US. Yeah, Prashant, please.
Roland, our colleague Venki Panchpagesan from IIM Bangalore has a question. Are short-term and long-term based, I guess, returns on ex-post holding period, or based on investor type classification?
So in general, we say this is more or less predetermined. We classified short-term investors by saying these are holding periods, so post-holding periods of up to 3 years. Later on in the robustness test, we also vary a little bit. So we go down to 2 years and up to 4 years to play around a little bit, but the results are pretty the same. But we also restricted at the lower end by saying it must be at least more than 180 days, because otherwise we will include this, as I said, the substantial renovations or speculative land trades and so on. So to exclude, for instance, these holding periods in general, but also for our definition of short-term investors. And that means in turn that larger than 3 years are long-term investors. Yeah? So we see later on, and on the next slide, we see also in the descriptive statistics that the average holding period is around 6 years, but including all investor types. Yeah.
And I guess that's based on an earlier paper that you cite as well.
Yeah, exactly. Yeah.
So our colleague from IIM Ahmedabad, Tanmoy Majila, is asking, isn't there a size effect? For example, large institutional investors can afford to create a portfolio and possibly bet against beta. So I guess you will address this later on in the paper.
Yeah, not directly. That's a good suggestion. It's a bit hard. So I will also, explain later on the cleansing process and how to identify the investors and the private investors, as well as the owner occupiers. So this needs a little bit more efforts to also, identify then among the institutional investors also, which are the big ones and the small ones and so on. So far, we do it only in a way that we say we have the private investors which have a second home or let's say, 2 other, homes or buildings, but not more compared to, these institutional investors. But we do not, distinguish explicitly between the different sizes of investors among the institutional investors. That's true. That could be, but then it's really, we have to go through all the addresses and then to see and rank them somehow. But this could be also driven. But we have to think about, when we think about, the investment in a single family home market, right, as an institutional investor. So this is a lot of, administrative work, right? It's different, when we think about an apartment or managing an apartment. That also was, I think there's some anecdotal evidence from the US which tells us that, some of these investors left the market again because there were high costs. But nowadays, as I also mentioned in this paper, when I cited the paper of Mills et al., that they also state that it becomes more beneficial. So they reduce costs and it makes it more attractive to invest in the housing market. Okay, but coming back to the data, or is there another question, Prashant? So
no, we are good for now.
Okay, so we have a huge cleaning process. So actually, we start with 100 million observations at the beginning, so close to 100 million. And then we have to exclude extreme prices, so lower than $5,000, higher than 100 million US. We also winsorized afterwards when we calculate the capital gain returns or the returns. We winsorized, for instance, the returns at the 0.05% and the 0.95% margins. Then we also exclude holding periods less than 180 days. We exclude foreclosures. So afterwards, towards the end of my presentation, we will again, look at these foreclosures. But first of all, we exclude foreclosures and REOs. So that means real estate owned properties. That means these are properties which are owned after foreclosure by the bank, and the banks they could not successfully auction these and sell these properties. We also exclude non-arm's length transactions and so on. So sometimes there's a missing sale or resale price. We also see that, for instance, at the very beginning in 1995, there are shorter holding periods. So afterwards in the robustness test, we also take this into account. So we allow for a certain burning period. But at the end, we come up with more or less 21 million repeat sales. So there's always a purchase and a sale, or a sale and a resale price during the period 1995 until 2017. This sample size varies a little bit. You will see later on when we look at our local return risk as well as momentum, which are based more on indices, on local indices, on repeat sales indices. So it reduces slightly. But sure, we also have to define the investor types. So when we have a mail address, for instance, and there's only one mail address, then we identify an owner-occupier. If we have no mail address, we use the suite address, and so on. So if there are, for certain properties or more properties, the same mail address, we know, for instance, this is a private investor. And then we have these company identifiers, so where we identify the institutional investors. So our key variable is the analyzed excess capital gain. That means we have to standardize this variable, and that means, first of all, we have to compare it with the same holding periods. So that means we calculate analyzed excess capital gains. So we have the sale and the resale price. And you see here in the exponent that we adjust for the holding period in years. And we do the same for the opportunity cost, which means the risk-free rate. So this is the second part here, which we subtract to receive the excess capital gains. But this is also the cross return. So again, we adjust for the holding period and we calculate analyzed excess return to make them comparable. And so this is our, as I said, our main variable. Then we somehow have to capture the local returns. That means the expected returns, which indicates momentum in the market. So we use the Case-Shiller repeat sales index approach to calculate this momentum measure or the local returns on the county level and also on the quarter level. So these are county quarter level data. And in the same way, we calculate local return risk also on the county and quarter level, where we use the dispersion of the local returns in a county C at the certain period T, and we normalize it by the nationwide volatility. So it's a kind of, excess volatility to the nationwide volatility. Yeah, Prashant, sorry.
So our friend from Rick's school, Ashish Gupta, is asking if you have some descriptive statistics on average annual return and yields in the US housing market.
Yeah, I will present you the descriptive statistics in a few seconds. Okay, so the advantage is that we have, property level data. So that means if we calculate, for instance, local returns and local return risk, then it's not affected by, let's say, index aggregation, or that we make a certain assumption about the autoregressive structure in the data, so we can avoid this. But as I said, later on, we will also, explicitly control for the holding period. So we have deciles, for instance, for deciles, dummy variables for the different holding periods. But in general, or to sum up, this data is county quarter level data. And here you see the descriptive statistics. So you see the number of observations. As I mentioned, for momentum and return risk, it reduces a little bit due to the fact that we have to calculate these indices. So we lose some of the observations. So the annual, and this is the annual, or the average annual excess capital gain is 4.2%, as you see here. So over all investors, over all these properties, and these are repeat sales. When you look at the median, and when we look at the purchase price and the sale price, so we see the sale price is larger than the purchase price. That makes sense. But we also see that this has a positive skewness. So as we have seen, in particular, in most of the years when we looked at, for instance, our distribution at the very beginning. So we have a lot of control. So we control for construction. That means if there is, for instance, new construction or a significant construction, which includes renovation, for instance, because it should not be biased by these, short-term investments and speculative trades. I already mentioned that we control for the holding period. So the average holding period is here roughly 6 years. But later on in the regressions, we will also explicitly account for the holding periods by using holding period deciles. And then we have a bunch of macroeconomic variables. So on the county level, we use unemployment, median income, population density, and we have some financial indicators such as the primary LTV. So CoreLogic also provides the loan to value ratio. So this is the average mortgage amount divided by the average price per county. Then we have a measure for liquidity. This is the turnover, which measures the activity in the market. And then our main variables, as I said, the county momentum and the county return risk. This is very important because we are interested if investors trade on this return risk in a certain county. So if they select a certain county with a higher risk and trade on this risk to receive higher returns. You see, the construction is only of minor relevance, so it's 1% of the entire data set. New construction is much larger, so it's 50 up to 16% here. You see the descriptive statistics for all the other variables. Now, when we split up the returns among our investor types, you see that the owner-occupiers have the lowest return with 3.5, and the highest is earned by the short-term institutional investors. But we also see, you know, here in the let's say the fourth column here with the standard deviation, we see that also, you know, higher returns come with higher risk. But even if you would calculate, for instance, a very simple Sharpe ratio, the ordering of these performance or outperformance would not change. Yeah, so this also confirms, you know, our motivation graph at the beginning. So it seems that short-term institutional investors outperforms, for instance, owner-occupiers as well as other investors in the housing market. And the question is, why do they outperform? What is their, you know, trading strategy? Do they have, you know, different investment strategy? Is it due to the fact that they have this different risk-taking behavior, and so on? And we want to start, you know, analyzing, as I said, if first of all momentum is relevant, or the local return risk. But before we start with the empirical analysis, I would like to spend some words on the methodology. So here we use a new approach of Höhli et al. In 2020. Actually, this paper is also co-authored with a colleague of mine, and I know that it's much older than 2020, but it's a new version. And this regression framework is a little bit similar to, it's very similar to what we know from asset pricing when we have these portfolio sorts. But it also allows us to calculate relative performance and to include all these investor types. So what does this mean? So here on the right-hand side, what you see is that we have alpha I, which indicates the types of investors, and we have the base category, which is owner-occupied. So it's always a relative performance. So that means if we interact alpha, the investor type, with the first vector of our covariates X, then we capture the relative performance. That means we interact alpha, so the investor type, with the intercept of this regression. But additionally, we can also, ask what is the exposure, coming from, let's say, momentum, and coming from, or is there an exposure to momentum or to the local return risk? So that means X, and that means again on the county quarter level, is for the volatility, and you see here T1 and T2. So we do this the same for both dates. That means for purchasing as well as the sales date. Yeah. So because the environment might change between the purchase or buying date and the resale date. So the exercise is always in 4 dimensions. So we distinguish between purchase and sale date, and we look at relative performance, and we ask, is there an exposure? So if, for instance, local return risk is a risk factor in our model, so it would explain a lot. So there will be no outperformance anymore, right? And the same applies to momentum by, again, controlling for these macro and financial variables. Yeah, Prashant, please.
Venki has a question. Roland.
Yeah.
Hi, Roland. This is Venki. Can you hear me well?
Yeah, we can hear you.
Yeah. No, I was just going back to your earlier slide on why the owners have lower returns, and I was just thinking, if you think about, I'm just assuming that you're looking at owner occupiers who are selling their property for some reason, right? So those are the transactions that you're picking under this category. So you would expect them to probably downsize or sell when the economic conditions are bad. So therefore, they are more likely to trigger their sales at the time when the market is soft. So therefore, seeing their returns to be the lowest is not surprising. So I just wondered what you thought of that.
Mm-hmm. That's true, but you will see later on, or in a few minutes, that we also control for the conditions, right? So the macroeconomic conditions, the financial conditions, and when we also introduce, for instance, fixed effects for the sale date as well as the purchase date, we actually control for that. So that means it's also included in our model specification. Yeah, so
Sure.
that means when I go back to my specification, so we have on the one hand side, we have the controls. That means we capture this unemployment income, but also the financial variables, as I mentioned, LTV and so on. So then we have also county fixed effects. That's very important because we can think about, if we exclude county fixed effects, then we can control, for instance, if there is a selection ability among, the investors.
See, I think, so Roland, just a hypothesis here. See, a fixed effects will not be able to figure out control for the conditions. So, for example, if I'm a homeowner, I do not have a choice. When I have to sell, I have to sell. So, if fixed effects assumes that you do have a choice, that at times when you can postpone the sales, and I'm just thinking, suppose if you see majority of the homeowners cashing out or downsizing their homes during bad conditions, I think maybe some part of it could be controlled by fixed effects, but I don't know whether there is a selection, self-selection in the sampling itself that might drive this. So I have to think through the econometrics of it, but I'm assuming it's not like other investors, right? The other investors, for example, you could have a short-term hedge fund who might be making quite a bit of money in other asset classes. So therefore they may be willing to ride through a bad downturn. But in the case of a homeowner, they don't have a choice. Just a thought. I don't know the mechanics of it, but yeah.
Yeah, you are right. But then we should definitely see a difference, in particular for homeowners, right, or owner occupiers, between the purchase and the sales date, right? Because if it's a kind of fire sale or forced sale, right, then there should be somehow a difference with respect to our main variables when we think about if they trade on local return risk or if they trade on momentum, for instance, right? But I agree, it might not entirely be captured by the fixed effect, but the main idea of this county fixed effects is, first of all, to control for, if we add them, so we control for, I would say, from finance, we know this when we think about performance attribution, right? So then we think about this selection ability. Yeah, so has the investor, the selection ability to select certain counties to invest. But I agree that might be a little bit different for, owner occupiers. That might be driven by other reasons. True. On the other hand, we also see that when I go back to my descriptive statistics, so we have a huge span. So 3/4 are coming from owner occupiers, where the shares of the others are pretty small, in particular for short-term institutional investors and long-term institutional investors. So I think when we think about the law of large numbers, I would say that these specific cases, in particular for owner occupiers, will more or less be eliminated. But sure, I have no idea to be honest, to detect these forced and fire sales in the housing.
See, one thing again, just a thought here, Roland. Let's say if homeowners have a distressed sale, chances are that they may not be correlated across counties. While if you think about some sort of a macro shock which is driving investor sales for the other categories, that might be probably, there could be some correlation across counties. So maybe you could use that knowledge to be able to tease out the two different effects.
I will come back to this because as I mentioned at the beginning, so when I talked about these foreclosures, right, I mentioned that in particular these speculative traders and short-term investors such as hedge funds, they were highly motivated also by the government to invest, for instance, in these foreclosure properties, and we use it as a kind of later on this foreclosure propensity as a kind of instrument, because you will see that later on we will discuss, are, for instance, short-term institutional investors drive the risk and vice versa, right? Is there kind of endogeneity and a kind of positive feedback, yeah? So the intermediaries, right, they drive up asset prices, yeah? So this is a kind of intermediary asset pricing case, yeah, where a certain class of investors also drive asset prices due to their investment behavior. Let's jump into the first result. So, or maybe I go back to the methodology. So to make it clear, so now in the next slides, first of all, I look at this outperformance. So that means keep in mind the reference group is always the owner occupiers. This is the interaction between the type of the investor with the intercept in this regression. And then in the second part, I ask, is there an exposure, right, to local return risk and momentum in the second step. So this is the interaction between alpha and X. So X indicates then the local return risk as well as the local momentum or the local expected returns. And you see also this comes with a T-1. So this is lagged to avoid this kind of endogeneity or look ahead bias and reverse causality. But I agree, this is a pure correlation, first of all, but we have also a bunch of control variables as you see here. So when I start, here with the first regression, so when I say here, this is the full sample, I mean, this also, pools the sale date as well as the purchase date. Yeah, so we do not distinguish between sale and purchase date. So this is completely the full sample with our repeat sales. And what we see here is the outperformance. So this is only the interaction with the first vector of this X matrix. That means now we more or less look at alpha, but these are relative alpha. So this is the relative outperformance to the owner occupiers because this is our reference group. So you see here, if we don't have any controls, if we do not control for fixed effects, we see that the short-term institutional investors outperform by 12.3 percentage points the owner occupiers, right? And the ordering is pretty the same as we have seen in our graph, and it remains persistent if we add, for instance, our control variables, the construction, new construction, but also the holding period. So that means the D size of the holding periods. And what's more interesting is that if we, include local fixed effects, where I said this might capture, for instance, the selection ability among the counties, so still the ordering holds. If we include purchasing fixed effects as sales fixed effects, so per quarter, for instance, here, then the ordering holds again. And if we go back, or if we go down from county quarter to SIP code quarter, fixed effects, it's still the same. So short-term institutional investors significantly outperform the others. And we see the ordering, so the highest return or capital gains or outperformance is received or gained by the short-term institutional investors, then followed by the private investors, and then by the long-term investors. So the long-term investors, keep in mind, this is more a buy and hold strategy. So you raised your hand, Prashant, or? Yeah.
Yes, I was trying to hold it for the end, but because this slide is already here, the Hochul et al. Method, I think that's fascinating because we are trying to do something similar, and this method is something that perhaps we could learn from. So we need to explore further. But one major variable missing from this kind of data in general is the rental yield, as Ashish has also pointed out. A major use of Case-Shiller index is derivatives, like Bob Shiller has been pushing for, although it has not been very successful.
Yeah.
But so they have futures and forwards on Case-Shiller indices. And if we are looking at any other set of investors who are directly investing in these assets, perhaps it is an important omission, the rental yield, because we are only looking at the capital gains here. And I was wondering, this is sort of a suggestion that because you already have information on holding period, could you also slice the data and compare subsamples across different holding periods? For example, people who have held it for very long, no matter which category of investor it is, they have also collected rental yields for that time period. And perhaps these dynamics could change if the holding period changes as well. So instead of having subsamples like this, well, these are not subsamples, but if you could simply slice the data and look at the difference in yields across different holding periods.
You mean rental yields, yeah? You mean rental yields, yeah. Yeah, so
because that would control for the rental motivation. So for example, second type of investor, short-term institutional investors, they're not really looking at rental yield, as you also mentioned in the paper. But can we also compare similar holding period across different types of investors? Mm-hmm. So the omission could be taken care of by the holding period itself, because you are controlling for all other factors anyways.
Yeah, but we also control for the holding period, right? This holding period here, the third variable here, the control variable is the deciles, right, of the holding period. So we control for different holding periods here as another control variable. The main problem with rental data is that, first of all, for the housing market, sure, it also includes apartments, but for the single family home markets, we have to use imputed rents.
Yeah.
That's somehow a problem. Then the second problem is that we, rents, they are also, somehow limited or restricted due to regulatory issues, right? So this is a highly regulated market. So that might also differ, right? If we look at different states or nationwide real estate markets, so then we have to control for that as well. And then at the end we said, okay, listen, in the capital gains, due to, we all know, to the discounted cash flow model, somehow it should be priced in, right? Incorporated in this capital gain, right? Okay. And so this leads us to the conclusion that we avoid taking into account and explicitly also, show the income return, right? Or the rental income. Yeah, so we excluded it. Okay, so then
Roland, just following up on the earlier question by somebody who's asking about the data.
Yeah.
You never thought of putting the market return there as a control? Given that these are investors who are trying to optimize across different investment processes.
Yeah, we do. Later on, we also, because so far we only look at two main channels, right, which we hypothesize. So we said, okay, we look at momentum because that's very obvious, right? So this has this autoregressive structure. Housing market returns are predictable, so momentum should be the main factor, right? And then we said, okay, there could be also this local return risk. But then later on, you will see we control for all other things, and the performance, the outperformance remains. So these are not factors which really affect and explains the outperformance or in general show some exposure to other variables. But I will, discuss this also in a few minutes. So now so far the structure is that, first of all, what you see is now this interaction between the investor types relative to owner occupiers, so the outperformance. And then, in the first column, you see we control for all these other, variables: construction, new construction, holding period, county fixed effects without local risk. So this refers to the local return risk factor. And then we distinguish between purchasing date, so this is the purchase quarter, and the sale quarter. And when we look at the purchase quarter, it's quite interesting. The ordering still remains and the outperformance is still significant. Whereas when we turn to the sale, it seems that the sale date has an impact. So that means if we account for local risk at the sale date, so there is no significant outperformance anymore. So it must be a factor. So local risk might be relevant at the sale date in certain markets, and they have an exposure to local return risk, for instance, in certain counties, but at the sale date. And we see here in the last column when we purchase and sale, you put it together. So there remains a slightly significant value for long-term institutional investor, but this also indicates this buy and hold strategy, right? They don't care about, more or less, risk taking and the compensation for the risk taking, because this is buy and hold, and they don't care about short-term fluctuations. Then in the second step, we are now interested in the exposure. So we include the interaction between the investor type, and now we have the exposure with, the interaction with X. That means here the local return risk in the first line at the purchase date, in the second line at the sale date. And then it's very interesting that, for instance, owner-occupiers, they demand, for instance, a risk premium at the purchase date, right? But there's a kind of risk discount, yeah? So a risk discount at the sale date, yeah? So the same for a private investor. But this, is totally the opposite when we look at short-term institutional investors, because they earn here a premium on the sale date, yeah, but they don't care so much about the purchase date. So it seems that there is, or that local return risk should be relevant, and that in particular the short-term institutional investor have an exposure to local return risk, in particular when they sell their properties and not purchase the property. So we do the same for momentum. In momentum, just to keep it very brief, when we lose momentum, nothing changes. So the ordering of outperformance remains. So it seems that local momentum is not really a factor which explains this. So we also see this here. We see that momentum is stronger in sales date, for instance, for short-term institutional investors. But as I said, when I go back to the previous slide, the ordering remains, and we see the stars for every coefficient. So there seems no change. For instance, that also means that momentum is not a relevant factor, which explains, for instance, these excess capital gains and the outperformance of short-term institutional investors. Now, coming back to the previous question, now we do the same exercise by using all the other indices, as you mentioned, national index. So this means the national housing market index, the stock market index, mortgage rates, but also these county income, unemployment, and county population density. And we see the ordering remains still the same. So that means the other channels that we see here on the left-hand side in the first column does not provide any explanation for this outperformance and these capital gains in particular for the short-term institutional investors. So they do not trade on the national index, right? So it's not driven their trading strategy on the national index. It's not driven when you said, for instance, institutional investors can switch between capital markets. It's not driven, by the stock market and so on. So they don't, invest in counties which are, where the population is very dense and so on. So it seems to be very heterogeneous, yeah, not only among the counties, but also within the counties. And it seems that the ordering of outperformance remains the same. We do the same if we have analyzed changes instead of quarter changes, as we see here. So the results remains the same. Now, in the next step, we ask, where do investors buy? So this is a probability regression. That means we do this now separately for each investor type. And here, the first column, we see the owner-occupier. So we give a 1 if the transaction was done by an owner-occupier, and 0 otherwise. And so we see the exposure to the county return risk, but also to the county momentum. So here, when we look at owner-occupiers, we see that owner-occupiers are less active in high return risk counties, yeah? And they also, trade more in falling markets than in increasing markets. This changes, for instance, by private investors. So there's more, positive momentum for private investors, but also a negative, sign. That means they trade less on momentum, or short-term institutional investors invest, for instance, in falling prices. But we see that we have a positive coefficient for county return risk for all the institutional as well as the private investors. So that means they have an exposure to this county return risk. So there are other effects which we see here. So income. So it seems that where income is lower, they invest more. This is due to the fact that they might rent, for instance, more. When we look at the county primary LTV, so if it's high, that means there's more supply of mortgages, so it becomes more affordable. So this is relevant for owner-occupiers, but less for the other investors. So that might be tight mortgage markets, and they invest to rent it out, right? Because it's not affordable for the households in general. So I think the results makes more or less sense. And then we ask also in the next step, what explains now local return risk? And we add a new variable, which is here the second variable. L stands for, again, we have lagged variables, as we did before. So this is the adjusted share of short-term institutional investors for the sales activity, because we have seen that sale is more significant or significant compared to the purchasing activity. And that means this is the share of all short-term institutional investors relative to all nationwide investments. So that means it's the share of short-term institutional investors' activities within the county compared to all, short-term sales activities nationwide. And what we see is that this is also relevant. So that means the share of short-term institutional investors drives local return risk, as we see, for instance, in the specification of 3. So we add county fixed effects, year fixed effects. So if we use year fixed effects, so some of the effects of unemployment rates, so the time varying effects diminish. But our main variable seems to be significant. Now you can say, okay, this is more or less correlation. This is not a causal identification strategy. So how can we, detect if there is not or take into account that there's somehow a reverse causality? Because if there's higher risk, that might attract, for instance, more short-term institutional investors. And at the same time, as we see here, they trigger, higher local return risk. So we need a kind of, IV strategy. And we borrow this IV strategy by Gupta 2019, published in JF. In this paper, he derives a measure which captures the spread between the LIBOR and the Treasury bill rate. So this is very in parallel until the global financial crisis. Then afterwards, it widens significantly. So there's a huge spread because the LIBOR increases significantly. And that means this is a kind of, measure or instrument for the foreclosure propensity. Why? Because if, properties are financed by LIBOR, so by, adjustable rate mortgages, so they are more likely to default or to become a foreclosed property. So we do the same or similar, we derive a similar measure by saying, okay, we use the LIBOR minus, and CMT stands for the constant maturity treasury rate. And we use the number of trades, so the number of trades which are related to LIBOR financing and subtract the number of trades which are related to constant maturity trades divided by the entire transactions in this local market. Why? Because you see this in this graph when we plot, for instance, the return at sale, and we have the REO, so the real estate owned purchases and the foreclosure purchases. We see that, if these measures are high, then with a time lag, we also see higher return at sale. So this is an indication that the short-term investors invest in these REOs as well as in these foreclosed properties, and then they also generate higher return at the sale date. So that means in our first stage regression, we use this instrument to fit the value for short-term institutional investors. And then in the second, we want to explain the volatility as we did on the previous slide. So we do this for both for the sale and purchasing date. And, according to our previous result, we would assume that for the purchasing date, there is no significant effect from short-term institutional investors on volatility. Sure, according to this graph, we would see in the first stage regression a significant impact because, they purchase it, right? So this is this foreclosure propensity. And this holds for, if they, resale it afterwards. So it should, be relevant for both cases, right? Purchase and sale. But for the volatility, only the sale should be relevant and the sale date, as we have seen. So this is the first result for purchase activity. And we see here our instrument is insignificant. Even so, in the first stage, we see that our instrument does a good job. It explains, for instance, this short-term institutional investors, the share of institutional investors. But at the second stage, it's insignificant. Whereas when we look at the sales activities, we see a highly significant value. And that means that, for instance, if we would increase by 1 percentage points the number of short-term institutional investors, or the share of short-term institutional investors, this would lead to a 1.6 percentage points increase. So relative to the nation, right? Because our local risk measure is relative to the nationwide volatility. So it increases it by 1.6. So it's also economically significant, this change in the volatility. So it seems that there is a kind of feedback loop, or a positive feedback between the share of short-term institutional investors and the risk. And so they trade on the risk, but they also at the same time, they increase the risk in these markets. So we also did a bunch of robustness tests, as I already mentioned. So we always used a one leg for the controls and our main variables, momentum, as well as our local return risk measure. We also tried 2 legs. We also used alternative definitions for short term. So we size it down to 2 years. And then extended it for 4 years holding periods. We use subsamples because we have a burn-in period at the very beginning in 1995. So we have a huge amount of short-term holding periods. So we start a little bit later with 2000, and we create these subsamples. And then we restrict all investor groups on the same holding periods of 3 and less years to see if there are some differences in their trading or investment strategies. So to wrap up, we see that the housing market is not only occupied by these homeowners. So we see there's also a bunch of other, investors, and they have different aims with respect to, risk-taking, holding period, and so on. And this creates a kind of heterogeneity. And in this paper, we want to get a better understanding how they trade and the exposure they have, in particular between momentum as well as return or local return risk. And that's, I think in the next step, we have also to elaborate a little bit about this. I mentioned this at the beginning, intermediary asset pricing. So how, for instance, these intermediaries, such as these short-term institutional investors, for instance, hedge funds, might also affect the markets and the price discovery process and the risk in these particular local housing markets. And then again, trade on, for instance, these different risk exposure. Yeah, that's it. Thank you very much for your attention. I look forward to your questions. Yeah.
So I do have a few questions asked earlier, but if someone else has some questions.
I think there popped up a lot of questions in the
So I've been
in the chat. I could not follow the questions, but
yeah. So in a way, your study says that the broad-based Case-Shiller indices are inadequate, and that kind of goes with the market rhetoric of why those indices have failed when it comes to trading in futures and options. For example, Chicago Mercantile Exchange, they do have these futures and options based on, I think, top 10 markets based on Case-Shiller index. But in a way, an outcome of your study is to suggest that, look, these broad-based city-based indices are not sufficient. we should also divide it into different investors type, because their risk exposures are very different from each other, right?
Yeah, that's a bit related to our other research project from which I took this first graph with the distributions, where we ask, if so in general, so if we look at the entire market, when we see that, for instance, the higher moments also changed, right? And the question is, are they priced, right? So our stylized world in finance is always a normal distribution, but we see that they are, far away from a normal distribution. And yeah, so the question is, are they priced, and what kind of fundamentals drive, for instance, these different types of contributions along the real estate cycle? So this is somehow related. And then we also have seen that this is very obvious for different investor types. I'm not so challenging these indices. What I said is that when we use this very granular data, and also Case and Schiller use CoreLogic. I think it's mainly based on the CoreLogic data, as said, but on a county level, right? So we get rid of this kind of index aggregation and some assumptions about the autoregressive structure, but it's a really a very micro level data, right? And that makes somehow the difference. I'm not so sure, how it affects. You might be right. Yeah, I agree. Yeah, so that it affects also the derivatives. By the way, this is a different project which I started with a PhD student, because I think it's very important to have these derivatives in the real estate market, because you cannot go short, right? And you cannot be pessimistic on this market, and so on. But
what I'm also certainly suggesting is that you could actually share your findings with Schiller, and he recently came up with a new venture called Macro Markets, and he's trying to push two types of securities to be listed on NYSE, where people could take short and long positions in the housing market. And by giving more granularity to the indices, I think your study kind of adds to the efficacy of those kind of securities. It's fascinating. I think they launched it in 2009 or something. 2000.
Yeah.
Okay, so
can I ask a question? One question? Can I?
Sure, Venki.
Just more like an observation, Roland. I used to be part of some of the largest hedge funds in New York. Goldman Sachs, and we used to trade real estate. And based on whatever you have shown, where the short-term investors would be probably the hedge funds that you're talking about, I don't see us making this kind of returns. And I was wondering why. Because if I look at your data, just correct me if I'm wrong, you are looking at investments in individual homes, right? I mean, that's the transaction database. And typically hedge funds don't do single house investments. They do through these either derivatives or through these somewhat related not just rates, even look at some mortgage backed securities where you're getting indirect exposure to real estate. So whenever we used to use real estate into our portfolio where other asset classes are there, it is not direct investment in houses. So I'm wondering whether the kind of people you are picking as short-term investors are largely people who are quite savvy in the local markets. They understand the trends. They're sort of, they're just floating a company, but really they're just 2 or 3 guys behind it, and not really a public or larger investment pool of funds. Because I don't see hedge funds looking at this as a huge money-making asset class. At least in the time period that you're talking about, which overlapped with my stay there. So I'm wondering whether, and also it shows that there are only 400,000 observations. So these are really across all the counties you're talking about, small outfits who are aware of the local conditions.
Yeah, that's right. And this question is also related to the size, right, of these institutional investors. I think that's a very good idea to have a look at these different types of investors. I think what's very obvious, and maybe Prashant, you can correct me, but when we searched around, right, I mentioned this at the beginning, right, in the other paper that we have written, when we searched around for somehow anecdotal evidence that other investors are active in the housing market, we found some anecdotal evidence of these hedge funds, right? And this was, as I said, yeah, they were incentivized by the US government, right, to invest in these foreclosures. Even though, you know, there were some comments on that later on, it was not very efficient because, you know, the managerial costs, the administration costs were very high. But there was another wave in 2012. As Mills have shown, that there are also long-term institutional investors investing in the single-family home market. So nowadays it might be more efficient, more cost-effective to invest in the single-family home market than maybe decades ago. So they also see huge portfolios of these properties. So it, at least what was written and what I take from this Mills et al. Paper, yeah.
Yeah, and Venki, this is kind of a relatively more recent phenomenon. In fact, a new breed of REITs has come in the US, which is solely investing in single-family homes. They may not be publicly, they may not be listed, but some of them are, if I remember correctly, public companies as well. And of course, there are many private REITs. So I don't have a breakup, but
no, but if you have REITs in your data, right, then you should also have a REIT sort of a fixed effect, right? Because it seems to me that as a portfolio, people would be looking. I mean, there could be quite an important capital constraint effect. For example, if somebody has a redemption request, or the REIT has to change its portfolio direction. So assuming if you have that additional information, you should be able to use that.
Yeah, that's correct. Yeah.
We just have 10 minutes left, gentlemen. So allow me, we have some questions. Devarpita is asking, can income of owner occupiers be used to differentiate between distress and non-distress sale by owner occupier sellers? It's a trick question.
That's a good question, yeah.
Can income of owner occupiers be used to differentiate between distress and, I'm not sure if, because a lot of people go for strategic defaults as well. So, okay, we have a question from Ishan Rukadia, and he's asking, it's India specific question, Roland, maybe all of us could help. Right now, almost all public sector banks are facing an issue regarding non-performing assets. So how we can overcome this issue? What are the necessary steps we need to take? So Ishan, these are good questions to ask. I'm just not sure if it's very relevant to this particular webinar. But our friend from Bangladesh has a bunch of questions. Arafat Khalid Chaudhry is asking that, is it possible that these investor categories could overlap? One particular investor type is outperforming the market. There must be some information asymmetry, or someone is much better at knowing it all about the market. So is there an overlap, a possible overlap across the 4 investor types that you have classified?
Not by, I would say, not by the definition, right? So I'm not sure what you mean with an overlap, but there's no overlap between these investor types. But I also thought about this as a next step, which could be interesting to know more about the spillovers, right? So that means we see, and we have also some maps where we see where these institutional or short-term institutional investors are active. Sure, you know, if they are somehow related to the foreclosures, right, we see them more, you know, in foreclosed or areas with foreclosed properties. Another question is also, you know, how does this affect the nearby, let's say, for instance, homeowners or owner occupiers, and vice versa. Yeah, so that means, is there a kind of interaction? So if, let's say, short-term institutional investors invest more heavily in certain counties, how does this affect, for instance, the prices and the strategies of owner occupiers or the other investor types in general. Yeah,
So,
that could be an next step. Yeah.
Khalid also has a kind of a suggestion. Professor Fizz, there is a debate regarding causal DAGs, directed acrylic graphs, where it would seem that a given correlation study might indeed be as strong as a causational one. Okay, thank you for that feedback, Khalid. He's also asking if REITs can be unlisted. In India, REITs have to be listed and public. In US, you have private REITs, you have public REITs, and within public, you may have listed or unlisted. So just in the interest of time, do we have additional questions for Roland from attendees and panelists? I guess that's it for today. We are right on time. Thank you everyone for attending this webinar. Thank you, Roland. And thank you, Abhiman, for leading this. We have more webinars in the pipeline, and I hope all of you will join there as well. Thank you, everyone. Have a wonderful night, and Roland, have a wonderful rest of the day.
Yeah.
Chuck, you have a wonderful day.
Thank you very much for the invitation. Yeah, thank you. Thank you very much.
Thank you. Thank you very much, Roland.
Riddhi, could we have a call among the panelists, please?